Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. In the U.S., there were no official government data given the shutdown, so that left private economic surveys to kind of set the tone for trading. Today's reading showed a fragile but stable labor market, so we had equities overcoming early losses and finishing at record highs. Meantime, global markets are now looking ahead to this weekend's leadership vote in Japan's parliament. The race between reformist Shinjiro Koizumi and right-leading Sanai Takaichi is too close to call. In a moment, we'll go to Tokyo for more, but we begin here in the States. Joining me now is Jeff Grills. He is head of EM Debt at Aegon Asset Management. Jeff, thank you so much for making time to chat with me. If you don't mind, I'd like to get your view initially on the U.S. interest rate environment, since we know that U.S. rates drive so much of the story when it comes to EM debt.
Well, we currently think that rates are slightly undervalued. Our view has been that all the tariff concerns that have been going on for 2025 and what inflationary impact that will have been overstated. Tariffs are a one-time adjustment to prices, other than just future changes, and therefore we don't expect them to be inflationary. So our view is that the Fed will have room to cut rates. The 10-year rate will have an ability to continue to go down lower, not dramatically, but 375 to 350, and we're already seeing a decline in 10-year yields. The 30-year might have a little bit more pressure, so we do think there'll be a steeper curve just because of fiscal concerns. But overall, the trend should be to rates being here to slightly lower over the next 12 to 18 months.
So if that comes to pass, what jurisdictions are you looking at in EM right now that you think would be the biggest beneficiaries?
Well, the big challenge for emerging markets across, which is the same for credit markets in general, is that spreads are at almost multi-decade tights. I mean, we really haven't been to these types of tights now since 2006, 2007, which everybody will recall was led into a more difficult period, which I'm not saying we're there. But so, we continue to think that you're supposed to have a combination of the stable credits that offer some value. So in Latin America, we still have a couple of favorites that we have. Colombia, which will get through their elections next year, but spreads are wider as a result of that, but we think they'll get through those elections. So Colombia is one of our top overweights. Costa Rica balances that. It's much more stable. It's got growth in the 3.5% to 4% range, so it will do well. Now, within Latin America, Argentina has been one that, for those that are braver, we've seen a big correction in prices in Argentina, with Argentine bonds going down about 20 points. There's been the headlines about the support from the U.S. and Besant. We think that Milei will survive the election, but that is the big risk. And we think that there'll be upside into Argentina. So for the riskier segments or portfolios that we manage, Argentina's where we're looking at least in Latin America.
So in the U.S. today, the equity market closed at record highs. There's a lot of debate in terms of where we are in this cycle and whether or not there's the potential here for a meaningful pullback in U.S. stocks, given the concerns about valuation and the fact that maybe the economy is slowing to an extent where you have to kind of reevaluate the corporate earnings story. If we do see the market wobble and there is a repatriation of foreign money out of the United States and into other parts of the global market structure, doesn't EM necessarily come out on top? Are there opportunities that you think foreign investors would take advantage of if they removed money from the U.S.?
No, EM probably would not be the first place that people would do in that type of scenario. I think that people would probably go back to developed markets, looking to Europe or other economies, at least to the more stable countries within Asia. I do think that it won't be terrible for emerging markets. I mean, in past times of that type of scenario that you just outlined, EM spreads could widen 100 to 200 basis points. I don't think that's the type of scenario that we're setting up for. But also because I mean, currently, I don't know that we're going to face major volatility. I mean, at least major downturn, because the spending on AI is still very strong. The PE ratios for some companies are very high, but for the main ones are, at the upper end of the ranges, but they're not the .com type levels that we had. So I still think EM probably does fine, but it would definitely underperform and not be the first place to go. Local markets have done very well, so I think if you got to pull back there, that would be the first place where people would start to go back in, since the local market trade still is one that most investors favor.
So talk to me a little bit about how the dollar figures into this. If we're talking about lower interest rates in the United States and we're talking essentially about a weaker dollar, how does that correlate with your EM trade?
Well, I think we've set off a path of a weaker dollar ever since the tariffs were first initiated back in April of this year. We saw a big 10% correction. Now we've stabilized around that. But our view is that the US dollar will likely weaken over the next 2 to 3 years, but not on more than a magnitude of 2 to 5%, right? So it's not that this is going to be a massive flight from the US dollar. The asset allocators, they just don't move their money that fast. They do it in 1 to 2% movements. They don't do it in 10% movements. So, but if we do have that depreciation of the dollar, I do. But as long as we have the low rates that go along with that, I think for EM countries and issuers, including the corporate sector, they're going to still be able to access capital markets at rates that are still very attractive to them, with growth rates that are higher than developed markets. So I think U.S. dollar assets will do fine. I do think, again, that you'll see local markets, they're more volatile, but local markets will probably still benefit from that. So countries like Brazil and Colombia and Peru should do fine. The Asian currencies probably more balanced, but we should expect both U.S. dollar assets and local market assets to do somewhat favorably, at least in a weaker dollar scenario.
So I'd like to get your take on the China story. We're in the Golden Week holiday right now. There's a lot of pressure, I think, that the government is putting on the consumer in China to really help ignite a little bit more domestic demand. How do you see the China story?
China's story is to us a two-pronged story. So you have the old economy with the consumer property sector and everything that has been going on, unfortunately, wrong with that. And we don't see the property sector necessarily spurring on growth too dramatically. And I think the consumer will be directly impacted by that. And that's the frustration in what you're seeing with President Xi. I do think that people should not underestimate how much support the government has been putting into the technology sector and into the things that they want to exceed at. They are excelling in the money that's being put into technology. They are excelling at EVs and other types of renewable energies. And so I know there's been criticism in the past, but they are definitely looking to grow. And the numbers have shown that. They've had pretty substantial growth there. And so I think that's helping them to offset their growth story, at least the weakness. It just needs to filter down to the consumer so that the consumer can get confidence. There's just really no place for them to go other than property sector, which is keeping them somewhat less vigorous with their spending.
So when we get to the trade story, a lot of the focus tends to be on U.S.-China. From the U.S. side, with a lot of the changes that we have seen in economic policy from the administration, do you have a concern of some type of diminishment in the influence of the United States going forward, that other countries, whether it's China, maybe even India to some extent, will begin to kind of develop ways of conducting business that are less reliant on the U.S.?
Well, I think they've already been doing that. I mean, I think the actions of the U.S. have clearly been more protectionist and centrist, but this is something that's been going on for a long time. I am not in the camp of that. I think that the U.S. is in big trouble today. I think we are still a great source of innovation, capitalism, the other things that will go with it. But you've seen central banks start to diversify out their reserves. You've seen people try to figure out ways to diversify their reliance on the U.S. Take Latin America, for example, right? They were wholly reliant on the U.S. 20 to 30 years ago. Today, they're now much more balanced, about a third to the U.S., Europe, and to Asia, China. So I think that trend will continue. The question will be who wins the technology race? And it's going to be an interesting one because China, as I said, is putting a lot of investment into that. The U.S. has been great capital spirits and innovation. So I think you will see that competition going there. The good news is they both are reliant on each other. So as much as we want to have this protectionist approach, at least in terms of America first, we are reliant on trade and we are reliant on investment. And so I think that relationship is not going to go away. And Besant said today there might be some news that can be positive out of China on that front.
So what's the one thing that you are most concerned about?
So the big thing that I get concerned about Well, two things. One, we are having exceptional growth. Everybody has been very cautious. Everybody's been very nervous about what will growth look like, and the market keeps surprising, or at least the GDP numbers keep surprising. So if we were to have some sort of more prolonged slowdown, if the labor force was weaker, that would be something that would make me nervous about risk valuations across most markets, including emerging market debt. That's not our central view. The other one that does worry me, and I'm a pretty positive on AI and what we're going to do in terms of the investment and the productivity boost it can have. But while PE ratios, as I mentioned before, are not necessarily my concern, the E is sometimes, because if innovation, as it normally does, figures out the way to produce things at a lower cost, then that E can go down, right? So the big the Mag 7s, the NVIDIAs of the world, which have a great monopoly and a great ability to do this, if somebody eventually does the true DeepSeek offset to that, you could start to see some concerns about, okay, what does that mean for earnings and what is that? I think that's just a correction. I think the long-term trend is still to stay in, but that could be a correction that could cause volatility for markets.
Jeff, we'll leave it there. Thank you so very much. Jeff Grills is head of EM Debt at Aegon Asset Management, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Japan is set to elect its second prime minister in over a year this weekend when the ruling Liberal Democratic Party holds a leadership vote. Now, recent opinion polls show Agriculture Minister Shinjiro Koizumi and former Economic Security Minister Sanae Takaichi are neck and neck. The new leader will replace outgoing Prime Minister Shigeru Ishiba. He was forced to resign after an historic upper house election loss in July. For more, we heard from David Boling. He is the Eurasia Group Director for Japan and Asia Trade. Boling spoke to Bloomberg TV host Shery and Avril on the Asia Trade.
David, great to have you with us. How different could Japan be depending on who wins this leadership election tomorrow?
Thank you for having me. Well, I think it's clear that Koizumi is the leader here among the five, and he's emphasized the importance of dealing with inflation. And I think that's the big lesson that we learned from the upper house elections, and why the LDP lost the upper house is that the Japanese public is very irritated with inflation. So I think that all of the candidates, whether it's Koizumi or Takaichi or Hayashi, and those are really the three who are in contention at this point, are going to spend a lot of time focusing on inflation. The LDP's playbook so far, though, has been that it is relied on cash handouts to households who are suffering from inflation. And I think the Japanese public is tired of that. What they would probably really like to see is a cut in the consumption tax. But the LDP is opposing that. The opposition parties support that. But the LDP is in somewhat of a difficult position because it doesn't want to cut the consumption tax, which is what the public wants. But at the same time, it does want to address inflation because it's a real incumbent killer, and they know that.
I mean, you mentioned Cabinet Secretary Hayashi, who would be a continuity candidate from Prime Minister Ishiba, who himself surprised in the election last year, which led to the Nikkei tanking the next day. Could we see a surprise, and would that mean a significant change in terms of policy or perhaps continuity as well?
I mean, let's remember this is an LDP presidential election, and so the candidates are largely in agreement, I think, when it comes to economic policy and the direction for the country. Takaichi is somewhat a different one because she's been a long time supporter of Abenomics, which is loose fiscal policy and loose monetary policy. So she's certainly one to watch, and I think that if she did prevail on Saturday, that you could see, some reaction from the markets because of her winning and her different views. I don't really think that Abenomics is the right prescription for Japan right now. It has inflation. Abenomics was there to deal with deflation. And I think that Takaichi even recognizes that some. If you saw that some of the debate forums that they had, even she moderated somewhat on her positions about spending and sounded a bit more moderate. I think she has to appeal to the moderates in the LDP to win, because the conservatives, the Abe faction that she relied on last year, has splintered and has smaller numbers.
Not just appeal to lawmakers, but also potentially for forming the coalition later on with working along with opposition. Who do you think has a better sense of engaging with those parties?
Well, I think all of the candidates in the debate forums have recognized that the LDP and Komeito have to expand their coalition, right? They do not have a majority in the lower house, which is the stronger of the two houses. They do not have a majority in the upper house. So they are going to have to move forward, and all of the candidates have spoken about the importance of moving forward to build the coalition. I think Takaichi's talked in terms of moving a bit more quickly than the other candidates, but I would see that any of the candidates who prevail will move pretty quickly to establish negotiations. I think there's negotiations going on right now. I think the party that is most likely to become a coalition member would be the Innovation Party, the Osaka-based party. They are aligned with the LDP, particularly on defense and national security issues. I think they're at a point now where they recognize they are not probably going to achieve national strength, that they'll remain a regional party, and this probably makes them more willing to join the coalition in order to have some influence, whereas the Democratic Party for the People, I think, is the other opposition parties is still on the rise and probably less interested in joining the coalition.
David, wondering also, when you look at the debt path, how do things look in terms of progress? You outlined some of the potential cash handouts that voters are perhaps frustrated with. Take that along with how a consumption tax cut doesn't seem likely. What are you seeing in terms of perhaps what the progress might look like?
I think it's tough. I mean, I'll be honest. I think it's a very tough environment. We all know that Japan's debt to GDP ratio is 250%, and this limits its ability to do a whole lot. It also is, having to spend more money on defense. It is on the path, to reaching 2% of GDP by 2027. I think the LDP intends to, keep pushing for that. I think the Japanese public supports increased spending on defense, but when you ask the Japanese public whether they want their taxes raised to do that, they're less enthusiastic about that. So the LDP is in a difficult position when you think about the current fiscal constraints that it's dealing with. I mean, these have built up over the years largely because the LDP has been quite willing to spend more money through supplementary budgets, which seem to become almost, an annual thing, and the LDP is talking about that now for the October legislative session as well.
Yeah, and of course, complicating the picture, normalization by the Bank of Japan. David Boling, good to have you with us, Director of Japan and Asian Trade at the Eurasia Group.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.